So the next section we have here is processing 1099 workers. In this case, I am actually going to skip over this section because it might not apply to everybody, right? Not every single person's going to have a 1099 worker, right? Especially when, looking at a business, your best bet is you shouldn't go straight into 1099 workers because there's lots of rules and regulations on contracting a 1099 worker. It's not as easy as you think it is. So in this case, I am actually going to skip over this section just because, once again, it does not apply to everybody. However, 1099 workers, right, you have to file the forms for the 1099 and you have to process 1098s for them, right, for their taxes and so on and so forth. And again, we're not going to be responsible for making any payments to their Social Security or Medicare or anything like that because they are independent contractors. They are responsible to pay into their own, some kind of retirement benefit plan for them and pay for their own insurance, right? All they are to the company is just a mere expense, right? We call them, we say, can you get the job done? And we just pay them straight up for the whole amount. No taxes are going to be taken out because they are not an employee. So we are not responsible for them for any reasons, okay? Even including if they do get injured on the job. Unfortunately, that's a situation where we're not responsible, right? We give them a contract. We say, this is what I want you to do. You complete it in this amount of time, and that's it. We just pay them for whatever price that they are looking at. So again, that whole section was about maybe 5 or 6, 7 pages right there. Again, it doesn't apply to every company. And if you do use it, then go ahead and take the time to go ahead and take a look over that. Again, this is in this book, right? It's more extensive on pretty much a lot of things that you can do in QuickBooks. So processing 1099 workers is that whole section right there, okay? But I am going to start talking about this section right here where we are managing equity. Managing equity, okay, especially depending on what kind of business organization you are, right? If you're a sole proprietor, this section is for you, okay, because it teaches you sole proprietors and what you do when you have partners. But in this case, when you are a corporation, it's pretty straightforward. It's pretty much done pretty much for you if you are a corporation. Because again, when we look at how much money you earn for the company, right, it's based on, again, your amount of profits, but it's also based on how many stocks you sell. So again, when we determine what equity is, right, equity could be in more or less terms, we can understand equity as our net worth, right? What is the company worth? What is it valued at, okay? And what an equity entails is if there was any investments involved or any means of taking money away. So again, when we look at the 3 different types right here, which is sole proprietor, right? What was your original investment into the company? What money did you take out for your own personal, payments, right? Because when we learn sole proprietors, the sole proprietors, the business and the owner is one, right? Where partnerships, right, you have multiple people putting in their own money in, and how we take money out is by distributing profits amongst the partners. And then for corporations, right, it's a bunch of people who own the company, right? And it's usually money is pulled in through stocks, the sale of stocks, right, by owning a piece of the company. And how the money is being distributed is through dividends. Okay, so that's the 3 main criteria here that you need to understand, is that each individual organization has its own different means of equity. However, equity in overall general terminology, if we just applied it in, just real life terms, you can understand it as your net worth of the company. Okay, so in this case, right, since the accounting class is looking at businesses at a smaller scale, right? We're looking into more things for sole proprietors in this class, okay? Because again, if you are willing and wanting to pursue some kind of degree in taxation or something like that, that's where you will be needing to take extra, higher levels of accounting to be able to understand corporations, because yes, it's a lot of knowledge and background knowledge and a lot of rules and procedures that you have to know that's completely different from a sole proprietor to a corporation, right? You're going from big company to a very, very large company. Lots of rules and regulations, okay? However, and again, so because we're focusing in this class, we're going to be focusing on a sole proprietor, right? Because again, you can't go from 0 to 100 right away, okay? Especially when you're learning a new trade, you need to start somewhere small and then work your way up to get to corporation, okay? And that's where we talk about CPAs are going to come into play, because you need to be a certified public accounting in order to work for a publicly traded company, okay? So there we go. So let's take a look at what sole proprietors do when it comes to equity, right? We must create these accounts, right? One for investments and one for owner's withdrawal. So as I've mentioned before, right, understanding how does a sole proprietor actually earn its money or generate revenue, right? Pretty straightforward. Its profits is going to be through the sale of whether you sell a product or a service, okay? But how does a sole proprietor get started when it comes to equity? And that's where you need to have your own capital contributions, meaning you got to invest your own money into your own company, okay? Or in smaller terms, right, you can take a business loan to be able to get the equity that you need. So in this case right here, we already have these accounts available: owner's investment and owner's draw. Okay, so this again is also known as your capital contributions, okay, which is basically your own money that's going to go into your company. Okay, so that's the first couple things that you need to have, because that's how you can get your net worth started. Okay. So now that we have those accounts, what happens when you do need to invest money into your company, or you need to be able to take money away from your company? It's straightforward, right? We've done these things before, where you are actually going to be making deposits and being able to write yourself a check, okay? Now in this case, that's exactly what I'm going to show you. So how do I get money into my company? Well, another way that you could do this too is you can simply just make a general journal entry. That's what this whole chapter is about, where we set up our account balances and so on and so forth. But in this case, right, we are looking into just setting up the company the way it should be. So in order for you to create those investments, right, we got to take a look at this in chapter 2, when we made our first deposit of money, right? That's how you get your company started out with some kind of money, or if in case you do invest money into your company, this is how you do it, right? There is no particular person or job that's going to be tailored to this, right? Because the owner is going to be the owner. All right. Now, again, from one account, you're going to be associating this with owner's investment. Okay, because you're putting money into the company. All right. Memo, again, you can type in owner's contribution. Okay, where the owner is going to put in a piece of their money in there to get the company started. Now, usually you can apply for a small business loan for this as well, but you do need to have some kind of lump sum money in order to start your own business. So in this case, I have a deposit I'm going to make, right, for the owner's investment. And what I'm going to do is I'm just going to make up a random number because this is just an example, right? So I can say that I wrote a check 65432, all right, form of payment. Again, I used a check. And how much was that check for? Again, because you're the owner, you don't need to associate it with the account number, the class itself. So in this case, maybe I want to invest $5,000. Okay. So when I make this and I deposit this in here, okay. Therefore, I just added $5,000 to my equity here. So if I go to owner's investment, I invested $5,000. Now let's take a look at this real quick because we need to make sure that we have our opening balance of equity. So right now it's standing at 0. Okay, great. That means our company's worth nothing right now because we didn't transfer our amount of profits in there automatically. Okay, which is completely fine. So you just want to make sure that you understand here when it comes to that kind of that when we start out with equity, it's right now it's reflecting as 0. But here I invested $5,000. But why isn't it in my equity? Because that's where our general journal is going to come into play, because at the end of a given accounting period, you need to close out all of your profits and loss accounts, right? Or your revenues and your expenses, and close them out to equity. And of course, that also comes with any investments or any owner's withdrawals are going to be included. So then your value of your company is going to reflect what it is at the end of the accounting period. So in this case, I added $5,000 to my equity pool, right? By using an investment, okay? Now let's say I do want to be able to write or take money away from my account. I would actually have to do that by doing an owner's withdrawal. So in this case, at the count at top right here, this would be coming from your checking account, okay? And, okay, yes, okay. And who is this to? In this case, it will be to, in this case, it's supposed to be Vern Black, or let's see if Andre is in here. No. So in this case, we're going to have to add them in. So the owner of this place or this company is going to be Vern Black. We click OK. And we click OK. We click other name. Okay, because an owner can't be a vendor, a customer, or employee. So in this case, what we're going to do is we're writing a check out to the owner. Okay. And the account that we're going to be associating it with is going to be the owner's draw account. Okay, and let's say he was very nice and only took out $2,000. Okay, and once that looks good, right, I can go ahead and click Save and Close. So now I took $2,000 away from my company. Let's see what it says here. Problem. Another check already has this number. Okay, cancel. So in this case, I'm just going to go ahead and click print later, save and close. Okay. So now once I've done that throughout the accounting period, your rule of here is now to create a general journal entry to close all of those amounts out to my equity. So how do I do that? Once again, go to make general journal entries, okay? And this time it's usually at the end of the month. So, okay, so let's say it's the month of January 31st, okay? And this is going to be the journal for number 5, all right? And again, we're going to have journal entries so we are able to find our journals, right? And in this case, now you have to think about this. You can add as many accounts as you'd like to be in here, right? including if you have repeat names in here. So that's just the way I understand it, is that you could do it like that so then you can make it easier on you to process one journal at one time. Now in this case, when we add money into our investment, right, what we're going to do is we're going to debit our owner's investment, okay? And we're going to credit our owner's equity. Okay, opening balance, partner. I guess we're going to do open balance for equity. Okay, there's no actual just equity account. So in this case, if you remember, we had $5,000 in there, right? So therefore, my balance should be $5,000. Okay. But so in this case, what you're going to say here is you're going to close out accounts to equity. All right. So again, you can copy and paste this for all. Now again, that's not the only thing that we had here. We had to take away from equity as well. So in this case, right, I could say, well, when I do an owner's withdrawal, that takes money away from my company. So therefore, that should cause a debit in my opening balance for equity. So opening balance for equity, and yes, you can add them all in here at once. Okay, I skipped a line by accident. So in this case, open balance, and I'm going to empty out my owner's draw. Okay, in this case, right, I took $2,000 out from these accounts. Okay, and of course, you can also paste in your note here. Okay, once everything looks good, right, and you know this is an adjustment entry, so make sure that it is checked marked as an adjustment entry. I can go ahead and click Save and Close. So just by listing out all of those, let's take a look at my accounts now. And this is what happens. This is what you need to do at the end of your accounting period. So notice this. My investments was 5,000, now it's 0. My owner's draw was 2,000, now it's 0. And let's take a look at my open balance right here, right? So if I started with 5,000 and I subtracted 2,000, I'm now left with 3,000. And that's how you are going to be processing this every single end of the accounting period, all right? And we'll talk about that when we take a look at what are the necessary steps to actually properly close out your accounting period in the next few sections here. But that is how you need to do when it comes to having equity, okay, as a sole proprietor. As you could see, if you're a partnership, you would have, obviously, the partners invest money, but if they want to take money, you would distribute the profits accordingly. All right, so that's why it's important that you know what kind of business you are and how to be able to manage your equity. And that's for sole proprietors, because that's what this class is. That's what you have to do at the end of the accounting period. Okay? Any questions there?
No.
Okay? So now we are finally going to be talking about closing the books. Okay? So here is your 10 steps on how, 11 steps on how to properly close out your books. So let's take a look. Number 1, okay, reconcile your cash, credit card, and your loans. Okay, so we talked about bank reconciliation in chapter 5. That is a necessary thing when you want to close out your books. Now, again, I mentioned this in the very, very beginning of class, right? What does it mean to close out your accounting period? Again, it's just a means to measure your profitability, right? But it's also in a way to sum up what you've been doing for that accounting period. So again, your accounting period could be broken up to daily, weekly, monthly, quarterly, annually, right? But most common that you will see is going to be a month-to-month basis, because that's a perfect measurement of activity that you've done per month. Okay, so when we go to accounting, we're going to be talking about what an accounting cycle is, which is a means to go through a series of steps in order to properly close out your books at the end of an accounting period. So in this case, this is QuickBooks version of the accounting cycle, right? In accounting, we learn a completely set of 10 different things that is similar to this, but it's not exact, right? In this case, this is just to properly start closing out the books. But again, in trying to make connectivity between the accounting class and QuickBooks, this is similar in aspect of how to properly close out your books. So these are the steps you have to take every time you are going to prepare for the next accounting period. So again, reconciling the cash and credit cards. We already learned that in chapter 5. Enter in depreciation, which we just learned today, right? How to do that. Step 3 says, if your business has inventory or any physical inventory, right, you need to adjust the inventory accordingly based on value and what you have on hand. We learned that in chapter 8. Okay, and then if you are using the accounts version of QuickBooks, okay, use the accountant transaction tool to confirm income and expenses were categorized correctly. Okay, so in this case, yes. Okay, we learned how to do that. And then number 5, if you are on the accountant's or the accrual basis or accounting, okay, prepare the general journal entries to help with these entries. Okay, so again, that's what this whole chapter was. And then close your equity, right? I just showed you literally 5 seconds ago how to close out your equity. In this case, QuickBooks automatically closes your equity account into, or your profits and your revenues and your expenses to retained earnings. Now, what you're actually supposed to do is you're supposed to close out your retained earnings to your actual equity. But in this case, I've also showed you how to do owner's investment and owner's draw and have that close out to your equity account as well, which is step number 6. Okay? Was that a question? Okay. So then again, right here, you're going to run reports for the year. So this includes your balance sheet, your income statement, your profit and loss, which is the same thing, your balance sheet, your statement of cash flows. You need to run all of those, okay, and print PDF versions of the following reports, okay? And then step number 9 is to back up your company. So you back up your data file. Step number 10 is to set a closing date. And then last but not least, you're going to consolidate and delete all of your transactions. Okay. So again, that is the whole entire steps that you need to take in order to properly close out your books. Now, in this case, right, we already going to be all the way up to step 9 and 10, because step 9, right, we've already learned, step 8, right, we already learned how to process those reports that are necessary for your company, which is your balance sheet, your profit and loss, right? Now, step 9 says to back up your data file. All right, I'm going to do that as the last thing for the class, so then you know exactly how to do that, okay? But in this case, we're going to skip number 9 and go straight to number 10, setting the closing date, okay? Now, what does the closing date actually mean, okay? So in this case, this is closing out to equity. So this is what I was talking about earlier, okay? Depending on what kind of business you are. Setting the closing date. Setting the closing date, in a sense, is to lock up your data file, okay? Now, what do you mean by locking up the data file? In this case, this is the accountant's job or the admin of the QuickBooks file, right? They are responsible to lock the data file for the purposes of protecting the sensitive data from being modified for potential fraud, okay? Especially because when you lock a data file, the admin is responsible to be able to make those changes when they want to in the close accounting period, whereas nobody else can be able to enter in any extra information in there. So again, if you don't lock your data file, right, and it's the closing period, right, anybody can go in there and write a bunch of checks to themselves and print them out and call it a day, and no one would know, right? Because month of June is already over. Month of August is already over. We're on September. Why would you write yourself a check in August, right? And that's where potential fraud can come into play. It's also where most mistakes can happen too, because if something happens in the month of September that affected in the month of August, let's say you processed a paycheck, right? And it was for the last week of August and you made a mistake, then yeah, you have to go back and fix that in the accounting period, which can cause holes and discrepancies if you do not do it correctly. So how do I actually set the closing date? Pretty easy. There are two ways that you can do it. All right. So again, when you set the closing date, what you're doing is you're going to be locking up the information on here. So how do I do that? You can go to company, all right, and you have set up a closing date, okay? Set closing date. And if you click onto this, it's gonna take you right to the edit preferences menu, to the very first tab on here, which is accounting. So that's the second way, right? You can go to edit preferences, click accounting, right? So here we are in company, and at the very bottom is going to be setting your closing date, okay? Now, again, you want to be very careful, because if you set the closing date for any reason, you will be locked out of your transactions, okay? So especially if you lock up everything, it's going to say, hey, it's going to give you an error saying you don't have access to make any changes in the accounting period. And they're going to ask you to enter in a password every single time, okay? So yes, it could be annoying, and that's exactly why. It's to prevent anybody else from changing any of the information that's already in the past, okay? So let's see, set the closing date, okay? Warnings, okay, so let's see, here, closing date through which books are closed, okay? So this is where you're going to be creating this date. So I'm going to go ahead and click set date and password. So again, only the admin has the capabilities to do this, all right? So again, you want to make sure that does it exclude estimates and sales orders. So again, if you close those out in the accounting period, you won't be able to use them. So again, I'm going to say yes, exclude them, right? Because anybody can have estimates and they can still be ongoing. You don't want to close those out, right? So again, what is the closing date? Again, recommendation is please do it sometime in the future. I'm going to go ahead and set this to be for next year, just so that I'm able to still do some more accounting in here. So again, I'm setting the date to be December 31st of 2022. Now again, you must set a password up. And again, you will get flagged if your password is not sensible enough or not good enough. So I believe in this case they use capital A, B, C, D, 1, 2, 3, 4 exclamation point. Okay, you need to make it that complicated. Okay, of course you can also show it so then you make sure that you didn't make any typos here. Okay, and I'm going to go ahead and capital A, B, CD1234 exclamation point. Okay, and again, you want to make it complicated, and it will QuickBooks will flag you if it's not considered a good enough password. Okay, so I click OK and it accepted that. So there you go. Now, if I go ahead and proceed and click OK, that means I've set my closing date. Okay. Okay. So there you go. That's how you do it. Now, again, you were also asked this on the very beginning when you created your company profile in the first place, right? You were also asked to set a closing date. All right. Now, in this case, if you're starting your company from brand new, you wouldn't know what the closing date would be until you actually go through the series of questions and figure out what your accounting period is. So again, most cases, you normally would do it at the end of the year or at the end of a given year, not every single time you have an accounting period, okay? So that is the rule here. So every time I try to enter in or change any details into a closed accounting period, it will flag you saying, hey, you need to have admin passwords in order to verify that you can make changes to this form. Okay, so that is setting up the closing date, all right, to lock up your accounting files. And last but not least, step number 11 is to use the condensed data. Now, in this case, I don't want to delete any of my transactions because I will be using this again for another time. But I do want to show you how to actually back up your company file. Okay, that will be the last step here, which is step number 9. So let's take a look here. We're going to go up to File, okay? And what you're going to do is you're going to click Backup Company, okay? Now, again, it's going to say, well, where do you want to back it up? You can create a local backup, meaning you're going to create a backup in the same computer as the current file, okay? Or you could create a portable one, which you can either save it somewhere else. But in this case, you definitely want to make sure that you do a local backup. All right, then you're going to get this window here where it pretty much says, well, okay, let's go ahead and set up where do you want to have these items backed up, and do you want to do it like right now? So it says local backup. You can even back it up online, right? If you have a paid subscription for Intuit where, when you buy the program itself, right, they give you some cloud space that you can, upload your backups to an online cloud device. In this case, I'm using a computer, so I'm just going to do a local backup. Now, then you can also choose options on where you want to place these items. So if I click on options, right, this is going to allow me to select the folder where I want to create my backups for. Okay, so in this case, I can browse and say, well, I'm going to go ahead and back it up in my documents under the QuickBooks class, and in this case, portable files. And I'm going to go ahead and create my backup file in the class. Let's see if it will allow me to do that, and click OK. And then it's going to give me options. Well, how often do you want to back up your file? Okay, so add a data. Okay, so in this case, do I have a limit of the number of backups that I can have in a folder? So how many times do you want to back it up, the file? 3 is appropriate. You can't do 0. You need to do at least 1 backup per folder. So in this case, I'm going to leave it as 3. Okay, and then it's going to say, okay, this is for online. And okay, so then I'm going to go ahead and follow through and make sure. So if you do an online and local backup, do you want it to verify that you're the correct user. You can do that. I usually click no verification and I click OK. All right, then it gives you an error message saying that here that you've told us to save the, okay, I'm gonna click change location or use this location. You're always gonna say use this location, so ignore that. So again, you do that. Now once you've done that, right, you're gonna go ahead and click next, and it's going to proceed on creating the backup for you. Now it's going to say, do you want to do it now? Do you want to save it for later? Or do you want to do it, you want to schedule it? Yes, you can schedule your backups. Pretty straightforward, right? Instead of having to do it now, you can schedule when to do it. In this case, I'm going to go ahead and save it now, just so that you guys know what happens if I save it now. And it's going to take me to this folder, and I'm going to go save it. And look at this. It gives you a date stamp and a time stamp of when you created this backup file. Okay, so it says right here, adjustments 21. It's a backup for September 28, 2021 at 10:56. Okay, so that at least you know which one is your most recent backup file. So that's the great thing about that, is that you can do that as well and save it. All right, and what it does is right now it's saving the file for you, and then you're going to go ahead and click OK. Now, yes, you can schedule multiple backups if you wanted to back up or save a copy every single time, whether you close out the file or whether you want to schedule it to do a bunch of backups behind the scenes for you. Again, that's going to be going through, doing setting it, like scheduling it, right? You can schedule your backups, but in this case, we already did our backup already. So again, you can explore those options. It does say in the book on how to do that. So especially scheduling how many backups you want in a folder, or how often, or if you want to save it every time you close. Okay, so you have those options there. Right, and that's how you back up a file. All right, so that is it for chapter 14, right? We looked at how to close out the books properly, right? We looked at the 11 steps to properly close out our accounting period, and so on and so forth. We took a look at what happens when we have equity, right? We took a look at depreciation and how to use a general journal, right? So any questions in regards to chapter 14? No. All right. So let's dive right into the review questions, multiple choice. Once again, your instructions is to select the best answer for each of the following. So number 1, okay, which of the following tasks does QuickBooks perform automatically at the end of the year?
C.
Letter C is correct, where it adjusts the balances in the retained earnings account and basically reflect the net income in that, right? I skipped over that. That was part of closing out equity. You just read that section right there, and it tells you that it automatically does it for you automatically, right? But the main thing is you have to remember that you must close out your retained earnings to your open equity balance account at the end of your accounting period to reflect that to reflect your profits if you are planning to reinvest into your company. Or you can take the retained earnings and distribute it to the profits to each partner. Okay, so I went over that. You had to read in order to know this answer. Okay. Number 2, entering a date in the close date field accomplishes which of the following?
C.
Letter C is correct. It locks the data file so that nobody can, yes, make changes to the actual file. Okay. Number 3, okay, voiding and deleting transactions both do the following. Okay, read this carefully. What do they both do? C for this question is correct. It zeroes out the debits and credits in each specific account by the transaction. Yes, okay? So let's look at this question because this can be confusing, right? It's not voiding or deleting transactions, okay? It's both of them. What do they both do? So in this case, A says keep the record in the data keep the record of the date, number, and transaction details, right? That is only for voiding transactions, right? Deleting doesn't do this. So in this case, we're finding a common characteristic that both deleting and voiding does, okay? Where it completely removes all of the dates and the numbers and details of that transaction. That comes with just deleting, all right? So that's the huge difference between the two. Now, what do they have in common? They zero out the debits and credits because essentially, right? If you're voiding a transaction, you're undoing it. So bring it back to zero. When you delete it, you're getting rid of it. It doesn't exist. So it zeroes out the debits and credits. Okay? So there you go. Okay. All right, so question number 4 says to make an adjustment to items as well as their associated accounts, use or create a what?
C.
This is number 4, correct. C, $0 check. Yes. In this case, right, it's saying you're making adjustment to items, okay? The only one that can do items is a $0 check. If it's just for a regular account, then you would use a general journal entry, okay? However, $0 checks can use accounts as well. $0 checks is dual. It can do for both accounts and items, where general journal can only strictly do accounts. Okay. Number 5, okay, at the end of the year, okay, you should perform the following. D, all of the above is correct, right? Enter in depreciation, okay, perform a physical inventory check, and if your business is a partnership, then distribute the profits amongst all the profits. Yeah, all the partners. Yes, right? This right here is referring to those 11 steps to properly close out your accounting books or your accounting period. So yes, these 3 steps these 3 items here are on those steps. Number 6, okay, to track payments, okay, to a 1099. Whoa, sorry. Okay, I guess my Adobe just decided to flash out. So sorry about that. Let me pull this back up again. Whoa. Okay. Now we're going to go all the way to the very end. Okay, so we were on question number 6, right? Okay, so question number 6. Sorry about that, guys. Question number 6 says, okay, to track payments, okay, to a 1099 vendor and print out form 1099, okay, accurately, you must complete. You must complete all of the following except. So again, you had to do your reading for you to be able to answer this question.
Is it B?
B, enter in the vendor's account number on the address information tab. Yes. Okay. So this is basically creating a 1099 contractor vendor to be able to help fill out the 1099. Number 7, okay, the IRS may reject the 1099 if you submit it.
C.
C, all right, the taxpayer ID is incorrect. Yes. So if you guys remember way back when in chapter 4, when we enter in our first 1099 worker, right? They asked for their identification number or their taxpayer ID, which is also, we use their social security, right? The IRS will use that social security number to run it to verify that that person is truly an independent contractor, right? Because, you know, they can write on their reports that they own a business, but they're not independent contractors. That way, you know, there's no fraudulent, you know, IRS situations that can go on within your company and a 1099 contractor. It verifies that they are a 1099 contractor. Okay. Number 8, okay? By creating a special bank account called journal entries,
A.
yes, you can see all the journal entries in the accounting register by providing SHS. A is the correct answer. Okay. Number 9, okay? When you purchase a fixed asset, okay, you should code the purchase to a fixed asset type of account. Yes, so if you remember, if you go in, you can create sub accounts. Okay, in this case, the sub account, right? You have your current assets, other current assets, fixed assets, and then you have your bank account, right? You should code it to an actual fixed asset account. Okay. Number 10, which of the following is not true about 1099s?
C.
Letter C, right, is going to be the 1099 wizard helps you prepare the 1099 MIS, 1099 INT, and 1099 DIV forms. Yes, okay, that is true, okay, that you have the 1099 wizard, which helps you fill those forms out. Okay. Number 11, which of the following is an example of a fixed asset?
A.
Okay, a $5,000 high speed copier. Yes, so in this case, right, this is something I forgot to go over because a fixed asset in QuickBooks, they say that in order to determine whether this item is a fixed asset is that it has a value of 5,000 or I think 2,500 or more, and that it should have some kind of life to it. Now again, $150 printer doesn't have the value of 5,000 or higher. That's okay, but it still has a lifespan. You have the choice to either use it as a mere expense to your company, or you can also depreciate it. Now in QuickBooks, that's just their rules. Again, you can as a small business, right? Any fixed asset that has some kind of life to it, whether it's worth $5 or whether it's worth $20,000, it's worth to go ahead and record. But in this case, this is looking for in a corporation standpoint, right? What is a $5 trash can to a corporation? It's chump change, right? Why would you want to use that as a fixed asset, right? At the end of the day, it's just a measly $5 trash can. So in this case, they just write it off as an expense to the company. But for a small company, like small business that can't really, they rely on, every single dollar that they spend as an asset to make sure that they look good on their books too. But just because they can't be, investing so much money into their company, that $5 trash can could make or break their company, right? I know it sounds funny, but $5 is a lot to a small business. Okay, where it is to a major corporation, it's chump change. Okay, so in aspect, yes, you do need to follow that guidelines in here, but in perspective of what kind of company you are, you ultimately make the decision whether you call it a fixed asset or not, or call it just a regular expense. Okay. Number 12, which of the following is false? C is correct. General journal entries are used to either reassociate funds from one item to another. Again, you cannot use items. That's why this is false. Okay? You can't use items. You can only use accounts. Okay? All right. So good job, everybody. This is the last chapter of this of the lesson, and little did you know, the answers are in the back of the book under your appendix in your book. So if you ever want to go back to all of these, your answers are all in the back of the book. Okay? I waited to the very end because I didn't want you to go forth and look at all the answers beforehand, because I like to explain how you get to the answers. Today, question mark? I'm sorry?
Oh, sorry.
Okay. All right. No, not geography, but QuickBooks, yes. Okay. And it gives you an explanation for all the review questions. So for example, right, I didn't go over the comprehensions. Your book has all the answers for each and every single one, including the fill in the blank options as well. However, and I believe they map out the page too for the, actually, no, they don't. They just give you the answer. So in this case, for the fill in the blank, you have all the answers there as well to go ahead and further on your comprehension, right? And of course, few things that I want you to do. I did mention this on the very, very first day of class, but if you don't remember, I do hope that these videos find you well to go through the whole book yourself. But the great thing about having portable files is, yes, you can go through the portable files as many times as you want, but you have to know every time you save the file, you must either one, make adjustments, or like change the title of the name, or what I say and I usually do is I delete the folder, right? Make sure it's completely out of your system, like go into your recycle bin and delete it, and then recreate that another folder, and then go through the exercises all over again. And you could do it as many times as you like, all right? QuickBooks will not do anything to it because once they're portable files, right, that's the way it is. Whatever file that it's saved that way, it doesn't save the actual dating file, right? By you creating a data file is where you can make changes to the file, okay? And I do encourage that when you are practicing this at home, utilize the practice problems, because again, this basically it helps you, it helps you keep yourself in check to make sure that you're practicing the ideas that were taught through the book, okay, over and over and over again, okay? So this basically reconfirms your knowledge for it, okay? Because the certification test question itself is very difficult. And again, I can't tell you what's on the exam because the exam changes for every person that takes it every day. Okay? No one student is going to get the same exact exam. It could be possible in if you take it months apart from each other. But again, the exam is different for every single time you take it. Okay, so you can be asked any questions that's in this book. Now, in regards to 1099, I highly doubt it. But again, make sure you use the study guide for your reading, and that's what we're going to go over tomorrow and Thursday. We're going to go through all the certification test prep questions, which is linked in your Google Classroom. We're going to go through all of it, and I'm going to have my my QuickBooks available so we can explore and exhaust the answers from point A to point Z. Okay, so we're going to go through every single detail. Okay.
How many times can we take the test?
What do you mean?
Like if we don't pass the first time, how many times?
The actual certification test, the actual certificate you have. So your agency, they give you 2 attempts.
Okay.
So they pay for 2 tests.
Okay.
And because in this case, the passing rate for the very first time is 40%. It's a very difficult exam. And usually the passing rate for the second time around is about 60 to 80%. All right, that's not that much. It's not like 100% guaranteed because, like I've mentioned before, it's a different exam every single time you take it. It's not going to be the same.
Okay.
So, yes, but for the practice exam, so I'm going to go ahead and forward an email to Casey to go ahead and purchase you guys those for who are not doing the accounting. You guys I'm going to save that for after your program, but for those who've already gone through the accounting program and this is the last part of your program, then I'm going to go ahead and request the practice exams from Certiport themselves. And what that certification practice exam is, like a mock exam, okay? It's not going to be identical, so don't think that this is the exam. No, but it will treat it as if you are taking the actual certification exam. It's going to time you 50 minutes. You have approximately 50 minutes with navigation and multiple choice questions, and you must pass. So in this case, the criteria is you must pass with a 70% or higher. In this case, for us to verify that you're ready for the certification, we want you to pass it with at least a 90% or higher. Okay, on the practice exams. Okay, the practice exams is from the actual certification tests themselves. It's the same company. All right, it's a mock exam. Okay, and we'll talk more into detail about that again tomorrow. But look out for your email. It doesn't come right away, so you have to wait maybe wait a week or so, just because there's other classes that are going on that are requiring the same procedures as well, getting the practice exams, getting all of that, and they do cost money. So it's part of your package. It's provided. So please wait patiently on when we can get that. But I will send an email out, so at least we can get that going. Okay? And again, I will, either me or my coworker will send out the instructions on how to redeem your voucher for the practice exams. And going on forth, I will also give you all the rules and guidelines on how to redeem and go ahead and, if you're ready for the certification exam, how do we proceed from there? Okay. All right. So